Hey everyone, in today's video, I'm going to be talking about 6 stocks that you may want to consider buying in your tax-free savings account. We're going to go over why it's so important to invest safely and securely in your tax-free savings account. In my personal opinion, some people may have a different opinion. And then I'm going to go through 6 stocks that I think really fit the mold of types of stocks that would fit well in a tax-free savings account. So if you like this kind of content, be sure to give this video a big thumbs up. It really does help get these videos out to more people with the YouTube algorithm. So I'll give you a second to do that. And also, if you haven't yet, consider subscribing to the channel. Talk about lots of stocks, Canadian stocks, US stocks, macro news in the economy and stock market as well. So be sure to hit the subscribe button. Okay, so reasons why, in my opinion, investing in your tax-free savings account smartly is so important. The opportunity cost of having poor investments in your tax-free savings account over decades is just too large to have a huge miss, an 80, 90, 100% down stock. And that's just because you're losing the opportunity to compound that growth tax-free on both the dividends and the capital gains over the course of your entire life. So even just a $10,000 investment made right today could be a huge game changer 30, 40, 20 years from now when you want to enter retirement in terms of the amount of annual dividends that $10,000 can compound into, the total capital position that $10,000 can compound into over decades. So I personally try to act pretty safely within my tax-free savings account, taking advantage of obviously not having to pay taxes on dividends, putting more and more stocks with ineligible dividends in there where I'd have to pay a really high tax rate if it wasn't held in a tax-sheltered account. So that's how I handle it. Some people on the other side of the coin go for moonshots in their tax-free savings account. Look for stocks that can 10x potentially, 20x, 30x in a couple years, just because that could really propel, their overall financial position if you can take all that money out tax-free. But in my opinion, being able to put in between $5,000 and $10,000 a year, depending on inflation in the given year, over long periods of time, if you just do it right and invest in good, solid dividend-paying companies who are positioned well for the very long term, you don't need to hit the jackpot on a 20x or 30x or 40xer. You'll be just fine at the end of the day. So that's my intro into the importance of investing in a tax-free savings account smartly, in my opinion, and the types of stocks to do it with we're going to get through right now. So the first stock that I think would make a great stock for a tax-free savings account is Savaria Corp. So this one here has a 3.7% starting dividend yield, Canadian company, about $1 billion value. If we look at what Savaria does, for those of you who aren't aware of the company, they actually operate in the elderly mobility space. So they have lots of businesses around home accessibility. You see these kinds of products that are like stair lifts in people's houses. They also have home elevators and whatnot, as well as commercial elevators. And that's been a really big business over the last few years as more and more commercial builders have needed to put these in to meet regulations and whatnot around the world. And then they also do things like patient care, in-house beds, canes, elastics, things like that for elderly people to enable them to stay in their homes longer, and automotive accessibility. So having changing or reconfiguring cars to be wheelchair accessible and stuff like that. Sometimes you see the Savaria bumper sticker on cars that have become wheelchair accessible by their team. So that's about 6 to 7% of the business as well, I think. So when we just look at the types of products that they sell, you can see that this really fits the mold for a company that is going to be getting a lot of secular tailwinds over the next handful of years behind just baby boomers getting older, needing more of these services, more and more baby boomers wanting to stay at home than previous generations, it appears, especially with what happened at old age homes during the pandemic, with what a crapshoot that was. Lots of people just want to stay home and manage their business and stuff like that from home with kids, with in-home caretakers versus going into older or elderly care homes. And all of those all of those trends, whether it's people wanting to stay at home longer or more people being baby boomers, really adds to Savaria's business and their different business lines that they can be providing investors. So looking at how they've been doing, they've actually had a bit of a tougher year or so. And that's because they've made a lot of investments to move production facility over to Mexico. Historically, they've been primarily in China, and just throughout the pandemic with all of the shutdowns and whatnot in China and just some of the geopolitical risks going on with relationships with China, they thought it made sense to move lots of plants or open up a new plant in Mexico in addition to the one in China. So they are currently a bit less efficient than they used to be, probably have more production capacity than they need. And they're still kind of growing into that. That's had a bit of a hurt on margins, as you'll see at the bottom, with EBITDA margins going down about 180 bips. But I'd say one of the things I've really envied about this company since investing in it years and years ago, if I look at the past 10 years or so here, I actually first got into this one in the high single digits, is just the CEO is I believe, the founder of the company still. And they really manage the company as if it is a private company, and really for the medium and the long term, more so than hitting the quarter, hitting the year. And I think especially when looking at a TFSA, that's a great trait to have in how a company's culture is and how the company's run. So looking at their dividend, longer term, they've actually been a pretty good dividend growth company. You can see here over the last 5 years even, they've gone from paying about 3.5 cents a month up 10% that year, up another 6-7% that year, up 5% that year, and then a 2-3% increase last year as they were dealing with some of these challenges around bringing more production over to North America and whatnot. But they tend to grow their dividend every year, so they've done a really great job at that. I'm even going, this is all the history that they currently have on this site. But I think even prior to that, they were even growing it previously. So it's been a bit of a dividend growth stock, in addition to having lots of long-term secular tailwinds that they're investing to capitalize on. Looking at their EPS, once again, they have a lot of investments in CapEx things they're making on the company right now that are trying to position them really well for long-term growth. They've made some acquisitions in Europe, which is what I was briefly showing here on this slide in terms of where they have production sites and sales offices and whatnot. So 30 direct sales offices. They're in Milan. They're all over Europe. They have, it looks like, a site there in China as well, and then all over Mexico, US, and Canada. So they're pretty well diversified on that end. But I guess what I was getting at is, even though the forward PE for next year is about a 16, 17, let's call it, they're really making investments and making sure they can drive revenue, drive earnings per share 5 years from now, 10 years from now, because they really understand and see that opportunity that they have ahead of them. And that's really what they're focused on capitalizing on, more so than 2024 or even 2025. So I'm really excited to go along on the ride. I actually do own some shares of Savaria in my portfolio. So a bit of a plug there, maybe a bit biased about this one, and this is just my opinion. But this is a stock that I really like, and it's not a huge position of mine, but it's one that I'm excited to hold. Going into the second stock here, it is Canadian Apartment Properties. So I've talked about this one before, but these companies have just been getting crushed recently. All REITs in general, just given the debt they have on their balance sheet. But you can see here, even in the last month alone, the stock's dropped over 10%, from over $50 down to $44. If you look at CAPREIT, they're the largest residential retail apartment REIT in Canada. They're currently getting a dividend of about 3.2% on this one. If you look at their performance here, they do about $2.40 a year, so pretty consistently doing 60 cents a quarter in funds from operation. So on their current stock price, they're trading for about, just doing some quick math here, but they're trading for about 18 times earnings. And I know that sounds expensive, but historically this company's actually traded for closer to 25 times earnings before. So it's really not super, super expensive like it sounds. And if you just look at the net asset value of each share given the value of the real estate. And this gets audited on a quarterly basis. Pretty much takes all the real estate they own in terms of full value, removes all the debt, and then divides it by the share count. That net asset value per share is $57. So when looking at the share price, that's 30% upside just if the shares were trading at what the value of the underlying real estate is. Forget the management team, forget the expertise, forget everything else that they bring to the table that they're trying to create value through. Just existing real estate is worth $57 a share. So I find that to be a bit comforting when investing in this company on these lows. Looking at some elements of their business here, they have 98.2% occupancy. So the residential rental market in Canada has been super hot. It's been really challenging for lots of people to get into rental apartments because it's gotten so expensive. Unfortunately, with interest rates going up, these companies need to increase rent because their operating expenses have just gone through the roof. And there's a huge housing shortage in some major markets in Canada, which is unfortunate as it is on a macroeconomy level. It just really provides a floor for these companies providing these services because we know that their occupancy rates will likely be in the high 90s going into the future here. Some other drivers of growth that Canadian apartment properties have is just a huge influx of student rentals as well, or students, international students as well, coming to Canada looking for short-term rentals. In addition to that, we have huge immigration targets in Canada, and once again, we're just not building to the capacity that is required to meet all of these strategies that we're doing in terms of bringing people into the country. So these properties, I believe, will continue to become more and more valuable, especially if you have a long-term view, like in a TFSA, 10 years out, 20 years out. Real estate has tended to perform really well. And in Canada, we're expecting to have very high population growth. I think that will continue to be the case here. And in addition to that, as you wait, you're getting a 3.5% dividend yield nearly, and you're buying in at 30% below what the current fair market value is for this real estate. So I think that makes it a great buy in a TFSA, in my opinion. One thing that the company is doing is you can kind of see they're kind of upgrading their portfolio. You see in the top half of the screen some of the more premium, luxurious rental buildings they've been acquiring over the last few years. And then some of the buildings from the 1960s and 70s that they've actually been disposing of that are a bit more beat up, a bit older, kind of falling apart to some degree. So I really like this exercise that they're doing to really upgrade their portfolio overall. And that's just something worth noting on this one. You can kind of see, you can freeze the screen and look a bit more, but they kind of go through a couple examples of just, this is an asset that they disposed of, this is kind of the quality on the inside, and then this is what they acquired on the right-hand side in terms of all the perks with solar panels and new finishes and new buildings on the acquisition front. Similar dynamics on this slide, so we won't go through them all. But if you want to see more of that, you can visit their investor reports. They have a lot of them. And then the last thing here on CAPREIT, they actually own a pretty sizable investment in the European residential REIT. So this owns assets, residential assets all over Europe. That stock's gotten crushed as well, I believe. So their equity position's been written down accordingly. But this isn't something they're just trading. They own it for the long term. So it's great to have that diversification as well in terms of some exposure into the European market through their equity investment in that REIT. They also get some management fees from them, I believe, from helping to manage it on the ground there and just their ownership position in the company. So that's just another stream of income that they have in their business. Going on to the third stock that you may want to consider looking at for your tax-free savings account, it is Alimentation Couche. So Alimentation Couche, we've talked about this one a couple times before. It's actually been roaring the last few years. We'll look at the past 5 years, up over 120%. But what I'll tell you is I remember looking at this stock 5 years ago, and they were trading at the exact same price to earnings ratio as they are right now. So just because the stock's up 120% doesn't necessarily mean they cannot continue to compound value at a high rate. So looking into this company, Alimentation Couche, for those of you who may not know, is one of the largest convenience store players in the world. And they also are one of the largest commercial sellers of gasoline to consumers in the world. So you look at their company highlights here. They operate coast to coast in Canada, pretty much all of US, and they lead markets in most of Europe as well. They've had an EBITDA growth rate of about 20% over the last decade and have been profitable every year since they went public about 40 years ago. Their return on capital has been about 15%, and they continue to have decent, I'd say, balance sheet grades on their business. Looking at a couple interesting facets of this company, in terms of their revenue and their sales, they've actually been really recession proof, and they haven't been too cyclical. And this actually surprised me just from a million miles away, not being overly close to the company. I would have thought people would be buying less gas during recessions, be buying less convenience products, but it seems like sales have actually ticked up a bit. And maybe that's more people at home just grabbing a bag of chips from their corner gas station and watching TV instead of going out on a Friday night or something like that. I don't exactly know the reason, but it seems like they've really solved the model in terms of how to slowly and systemically, organically grow year over year in addition to the acquisitions that they've made. So that's a really nice view. And on lots of their charts, you'll see they show like a 20-year, 30-year trend. I think it really goes to show just the long-term mindset of this company, which is exactly the kind of company and mindset I want for a company that I want to plug in my tax-free savings account for the next 20 years. Continuing on here, they don't just operate in Canada and the US, they actually have a pretty decent presence in Europe, and they've expanded into what look like the Southeast Asia, let's call it region, a couple thousand stores there. So overall, they have like 15,000 locations here. So about 9,000 in the US and Canada, and then about 5,000 there in Europe and international. So really big global footprint, obviously other opportunities in other markets around the world, and they continue to expand into new markets, mostly through acquisition. Acquisition's been a really big driver for this company, and you can kind of see here some of the acquisitions that they've made over the last 20 years, and they've really been able to have a really strong track record on synergizing these acquisitions. The reality is, with this kind of business, the more storefronts you have, the more locations, the more countries, the higher amounts of fuel you can buy, and the more negotiating power you have to get the best rates. So going from a 4% margin on fuel to a 5% margin on fuel is a ton of money, because fuel margins are so slim and so low to begin with that if you can just extract an extra point, an extra 2 points of margin, it's a huge competitive advantage in terms of free cash flow to fuel the business. The other side of it is on the convenience side. Same thing. If you can squeeze vendors like PepsiCo, Coca-Cola, etc., for an extra couple points of margin or lower costs, that can go a really long way in fueling your growth. And even with private label, which is a really big element of their business, they own the Circle K brand, which they're really rolling out globally right now across all of their gas stations or convenience stores, rather. And being able to put in production runs for Circle K private label products for 15,000 stores, and I know there may be some local regulations in terms of packaging, languages, stuff like that, but generally speaking, way more efficient and way harder to compete with that on a profitability standpoint versus a mom and pop gas station or just like your corner store across the street, who's definitely not getting the pricing from competitors or pricing from vendors that a company like this is, definitely not getting their own private label banners, definitely not getting all the expertise and data that Alimentation Couche is working off of. And over time, over 2 years, 5 years, 10 years, that competitive advantage compounds. That additional point of margin that they're getting on fuel, those additional couple points of margin they're getting on products inside the store is just a bunch of new free cash flow that they can use in investing in being first on electric vehicles, investing in R&D on different styles of products and business models and opportunities to grow the business, investing in synergies and margin expansion opportunities. So it just continues to compound the growth, and 10, 20, 30 years from now, they'll be so far ahead of the mom and pop stores in this space, and there's a ton of them. Looking into their dividend, and I know dividends are great. I'd say dividends are a part of the story here. I think they pay about a 0.8% dividend, give or take, so it's very small. I wouldn't buy the stock for the dividend, but it's nice that it's growing. So once again, was just $6 million a share. 10 years later, not even 10 years later, it's over 40. So it's like 7-8x. If they're paying a 0.8% dividend and it's 7-8x again in the next 10 years, that will be a 5% yield on cost. So once again, looking out 10, 20, 25 years, hopefully until your retirement, and getting in early on these, even though it looks like a 0.8% dividend today, when you're retired, a company like this, if it continues on the path that they've been on, maybe paying you a 20, 25% yield on cost that you can just be getting in passive income, tax-free every year to help you aid a really healthy retirement. Looking at valuation on this one, so they're trading for about 16, 17 times next year's earnings, so not a crazy multiple to get into this one. Obviously, some people are concerned on how well they'll be able to pivot to electric vehicles and electric charging, since lots of their business is gas. If more people can charge their cars at home, will they be coming in to the gas station and the convenience store to the same degree? So lots of these things, the jury's still out on. But if anyone's going to figure it out, it's going to be them, just given their scale, given how big their business is, and their ability to kind of stay on top of these trends over time. Okay, so that is the third stock to watch for in your TFSA. The fourth stock here is CIBC Bank. And CIBC Bank is, just to put it bluntly, a great value opportunity in my opinion. These banks have done really well, generally speaking, over the long term. You see here up about 600 or 550%, not even counting the dividend in the last 30 years. Count the dividend on that, it'll double the overall shareholder return. And at current levels, the banks are just trading at very cheap valuations, in my opinion. So CIBC here currently paying a 6.7% starting yield. So unlike Alimentation, Couche, you can start getting almost 7% paid to you in your TFSA today, and you can use that 7% to buy more shares of it, to compound your own dividends on an absolute basis by reinvesting your dividend, or taking those dividends and investing in other stocks. So it gives you a great current starting yield of passive income in your TFSA to go shopping with, and that 7% you get is going to be tax-free. You can spend all of it on new stocks to compound growth your own way in your TFSA. Looking at their business a bit, and I've gone through this, so I'm not going to, in other videos, so I won't go too far into it. I did a video on 3 bank stocks I own, CIBC being one of them. If you want to check that one out on my channel, I'll leave it in the description of the video, but you can kind of see how their net income breaks out here. Somewhat diversified, I'll call it, from a business unit standpoint, not overly diversified from a region standpoint, but overall the company is just dirt cheap. Company is currently trading at a price to earnings of 7.5 to 8 times for next year. They're going to do almost $7 of EPS, and they're trading for 50. So that is super low if you just do the math on that. And when you look at their dividend history over time, they have a really solid dividend growth history. So not only is the 6.7% dividend likely not at risk, in my opinion, just historically speaking, back in 2011, it was 43.5 cents a share. And you can see they've pretty much increased it every year, currently trading at 87 cents per quarter per share. So quick math, they literally doubled the dividend in the last 12 years. So you're looking at a company who's doubled the dividend in the last 12 years, has a starting yield of 6.7%, and is trading at 8 times earnings. And I think you would be hard pressed to find me another company that is currently currently having all three of those metrics right now. Give me a company trading under 10 times earnings with a double up in their dividend over the last 10 years that's currently yielding over 6.5%. I think that would be very hard to do just because typically the companies who've increased their dividend at such a steady rate demand a premium or at least a market multiple, not a very discounted multiple like this one is trading at right now. So those are my overall thoughts on CIBC there. The fifth TFSA stock you may want to consider buying is Pizza Royalty. So this one's been going down the last few weeks, but you can lock in a 6.8% monthly dividend yield on Pizza Royalty Corp right now in your TFSA. And these dividends are ineligible, so you get taxed really high on them if you have them in an unregistered account, which makes it a great stock, in my opinion, to have in a TFSA account because you get all the benefits of a royalty corp. That steady flow of income on a monthly basis to reinvest wherever you want it in your TFSA to compound more and more dividends and build that dividend snowball over the long term. And you don't have the con when you hold it in the TFSA of paying that high ineligible dividend fee. So in my opinion, great stock, great business, very defensive, and great place to hold it. So it's a match made in heaven. Looking at some of their brands here, primarily the business is Pizza, but they also own Pizza 73 out in Alberta. And they just opened up their first 2 or 3 PZA pizzerias in Mexico. So that's a really interesting growth opportunity from a geographical standpoint. But for the most part, this is just a really strong income play in my opinion to get really good yield in your portfolio right now. These kinds of investments can really offset some of those ones that you're playing the long game on, like a Savaria with a 3.5% starting yield, like Alimentation Couche with a 0.8% yield or whatever it is. That kind of stings right now when you also want cash flow to reinvest and grow the stocks you're holding. So it really helps when you have stocks like CIBC, Pizza Royalty as well, paying you a 6-7% starting yield. So then your weighted dividend yield's more like 4 or 5%, which you can really go on some shopping sprees with throughout the year to build your TFSA organically, or not organically, but inorganically, as well as just stock prices appreciating. And then just some information on Pizza Royalty for those of you who may have not seen other videos I talk about it. Primarily an Ontario-based chain, 500 chains here, but they do have 100 out in Alberta with Pizza 73 and 60 in Quebec. The rest is pretty small, as you can see. So you're really investing in the Ontario market on this one. And then the last stock is Canadian National Railway. I own this stock in a big way in my personal TFSA. This one's actually been going down the last month, so I've actually been buying this stock a bit more recently, currently trading at a $95 billion valuation, 2.2% starting yield, and about an 18 times PE. So let's just take a look, and I'll talk to some of this in my opinion here, but they've done a really strong job here in the last 5 years of growing their dividend. You can kind of see they've grown their dividend on average about low double-digit CAGR over the last 10 years, and they've increased their dividend every year since going public in 1995. At the end of the day, these railways, whether it's CN Rail, Canadian Pacific Rail as well, they just have such a strong moat. No one's building new railway tracks. So many of their customers are in geographies that they have no alternative to ship with anyone else except for the railway company that is in their town or near them to get their products out to the market, whether that's farmers, whether that's oil companies or whatnot. So huge pricing power, let's call it, for lack of a better term. And in addition to that, these companies are very heavily diversified across the economy. They do they do oil, they do intermodal, they do imports, they do exports, they do all kinds of lumber and other goods across the economy. They do automotive, and typically, generally speaking, as some sectors are declining, other ones are increasing. As the whole economy goes, it tends to be relatively stable, except for when the economy gets really bad or we go into a recession. But they've still shown the ability to increase their dividends throughout those times, continue to be increasingly profitable as they move through those periods and into greener and greener pastures. So, my opinion, great company just because they have great staying power with the moat that they have on this company. They have a decent starting yield given the growth rate that they've been growing it at. And I think CNRail will definitely be here and serving the North American economy, which is the best economy in the world currently, when I am ready to retire. Looking at their dividend yield, we just looked at that. But the other thing that I really liked about the company is they also buy back tons of shares. So since I started holding the stock, they went from about 950 million shares to 660 million. So in 10 or 20 years, when I want to retire, 20 or 30 years actually, they will likely have a way lower share count, and I'm probably never going to sell a share. So I'm going to own a much bigger chunk of this company, which will still be increasingly relevant in the North American economy, and I think that's a great place to be in terms of asset to own in my TFSA. Getting that 2% dividend in addition to getting more and more ownership year in and year out in terms of driving a really strong long-term shareholder return. Going into the earnings per share here, expected to be $8.25 next year. They had a bit of a tougher year this year for a couple of reasons, but $8.25 next year, which will be about 18 times current stock price. So about 18 forward price to earnings on this one. Historically, I've owned this stock for years and years. Before the pandemic, when interest rates were a bit more normalized, this one used to trade at 21, 22 times. So I think at 18 times here, in my opinion, being an investor who's going to be holding this one over the long term, I think it's a good opportunity for me to continue to average into CNRail. I'm not averaging down on CNRail because I've actually been buying the stock heavily for many, many years here. So my average price is probably closer to 100 or the early 100s, but I still think it's a great opportunity where it is now, given how much the business has grown, given how much lower the share count is today than back then. So yeah, I'm still buying this one, and I hope to buy a bit of this stock every year as long as it's at a fair value from now until when I retire. I think Warren Buffett once said it's better to buy a great company at a good price than a bad company at a great price, something along those lines. And I really feel like that applies here to CNRail. I think a TFSA is the perfect place to own it, just given their long-term prospects and I think relatively limited downside given the moat that they have on this company. So I hope you'd like me reviewing these 6 stocks that you may want to consider adding to your TFSA for long-term growth. If you like this kind of content, be sure to give this video a big thumbs up if you made it to the end of the video. Also, please consider subscribing to the channel if you haven't already. And if you have your own TFSA favorite stocks, would love to hear them in the comments below and give my 2 cents as well. I'll see you guys in the next one. Bye.